So what is a valuation cap? Today I want to talk about valuation caps, which you often find in convertible notes or safe agreements. Startups often use convertible notes or safe agreements in the early days to help fund the business and get early stage investors, angels, others into their cap table. For our purposes, I'm going to focus on the convertible note. Convertible note is a loan that converts into equity, as its name suggests. It's often used in those early financing rounds. Here's how it works. Convertible notes, they're used to get funding in early without defining a valuation up front. A convertible note can be particularly beneficial if you're not yet selling a product, if you still need to do some R&D, any reason that you want to delay establishing a valuation of your business while you're selling equity. It lets you grow value, grow the valuation before you actually sell that equity. It gives you a chance to grow the company and get a higher valuation. So why are valuation caps important? They're important because they get investors to invest in your company. As a company, as a founder, you don't want a valuation cap. But as a founder that wants to bring in capital, it's often going to be required as part of your convertible note. The valuation cap is designed to set a threshold for the convertible note, meaning that the monies that are brought in on that convertible note, those investors, their money will, at a maximum, convert at that valuation cap. It lets early stage investors potentially capture more upside and convince them to bring their money in so that you can put it to work to build your company. So how does it work? A valuation cap, let's say that you have an investor that, as a group, they put in $1 million with a $10 million valuation cap. You actually raise money later that converts that convertible note into equity, and you do that at a $20 million pre-money valuation. Without the valuation cap, these convertible note investors would only own about 5% of your company, that 1 million out of 20. With the valuation cap, their money is going to convert into equity at that $10 million valuation, giving them a higher stake in the business. So you're probably thinking to yourself, why would you want further dilution? It really is to be able to drive that investment early and to give those investors some extra upside when they come in, because they took early an extra risk compared to the new round of funding that's coming in at that higher valuation. So it really gives you the ability to bring money in, close money, and put it to work so that you can get cranking. A valuation cap is a great way to protect investors from small equity percentages during subsequent rounds of valuation. If you're interested in talking about convertible notes, safes, valuation caps, or you're confused by it, give us a call. We love to do scenario planning on cap tables and help you understand how these things are going to impact you, your team, and your current investors going forward. Thanks.